Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. We had the two key market moving events yesterday, but it seems after moving overnight, markets are back where they were before the event. RBI maintains status quo on the rate decision while using incremental cash reserve ratios for additional deposits banks may have gotten due to the overhang of the withdrawal of 2000 rupee notes. When it comes to the US CPI, it was broadly as expected, with headline core year on year figures coming a tad lower than what the markets were expecting. The reaction, none to the RBI policy, but post the CPI, we saw dollar weaken, but things reversed overnight and dollar is back where it was before the CPI. Morning, JK. Very interesting set of moves happening. US yields have also shot up. Dollar is back where it was. How are you reading all of this?
Good morning, Swaraj. Yeah, I think as you mentioned, there were two important events yesterday. Obviously, RBI decision to hold rates and liquidity measures did not have much of an impact on Indian markets, except stock market taking some much needed correction. Rupee, of course, saw some strength later in the day. That's just back on the back of the fall in dollar index, which was trying to discount a lower CPI number. Other than that, most of the day, dollar rupee was well bid above 80 to 80, and offers from state-run banks kept it below 80 to 85. But that CPI data was very interesting. And, while it gave a lot of comfort to the Dows on the first look, it has elicited mixed response from investors and analysts. And year on year saw very modest decrease in both, in the core inflation, while the headline was, higher, but less than what was expected. And some are looking at the super core inflation stripping out food, fuel, rentals, and used cars, not budging, and are not sure if peak rates were seen. So while the markets had differing opinion, I think what we should look at is the official view, and the official view came very loud and clear yesterday from San Francisco Fed President Daly, who poured cold water on a Fed pause in September, and let alone the rate cuts. And she said it's too early to say whether Fed should hold or hike rates. She's data dependent and notes that the CPI coming in as expected was good news and in right direction, but not a victory in Fed's inflation fight, and that there was more work to do. And she's also saying that the key price data that Fed will be watching would be the core services inflation, which has not made much of a progress. So in what appears to be one of the wildest seasons, yields have been moving massively both the ways. After a steep fall seen post US jobs data, we had once again a big rise in the long bond yields yesterday. And this came, after a very weak CPI and the rise in jobless claims by 21,000. Previous day, we had seen a good response to the 10-year note auction that, kept the yields lower. But yesterday's response to the 23 billion 30-year bond auction received a very poor offtake, with yield pegged 0.1% higher and one of the largest allotments to the primary dealers. And this led to a massive rise of 16 basis points in the 10-year and 13 basis points in the 30-year from their respective lows. The stock market and the dollar obviously took cues from these moves and also daily statements. So the stock market at one point of time was 1% higher in all the indices and ended almost flat and giving up almost all the gains. And it's also due to the fact that most of the run up in the markets in the last 5 months have been backed by the expectation of a rate cut, but that seems to be pushing further backward. So that's leading many players to take profits whenever there is a sharp rise. And I don't think we are going to make much headway in the near term, at least not in this summer illiquid conditions. And similarly, on the dollar also, we had a big rise in the currencies, Euro, GBP, and even yen strengthened somewhat immediately after the CPI data and also the jobless claims. But once the yields started rising, the moves have been completely reversed from a minus 0.7% fall to plus 0.1% is how the dollar index moved, and euro and GBP. In fact, GBP has been much lower than where it was before the CPI data. Perhaps market slightly jittery ahead of a slew of economic data from UK today, including GDP, trade, and also the industrial production, because the UK has been seeing one of the massive rises in borrowing costs and the policy rates, and expected to go even higher. Yen, I think, has seen a new low in the last 2 weeks, almost touching 145, which is a very sensitive level from Japanese official point of view. But yen's rise, rather the dollar yen rise, had a lot to do with the yields rising in US, as well as a rise in the oil prices, which starts to bite the Japanese economy. Again, Japan had just started to see some improvement in their current account, but I think with this rise, once again, there will be some stress on the current account in Japan. Now, a completely different story is the Chinese yuan, which continues to be the weakest currency, as a host of factors like weak economy, geopolitics, and negative yield differentials pressure the currency. The continuous efforts of central bank fixing the daily rate below market's neutral estimates, and also some direct intervention in by selling USD against yuan, have not helped any recovery. Of course, the geopolitical factors are coming to the fore once again. Yesterday, we had a decision by a Biden government to ban some of the exports to the some of the US investments in China in sensitive technologies such as computer chips, and request government notification for investment in other tech sectors as well. In fact, we are also noting a massive fall in the Taiwanese dollar in the recent days, and people are ascribing to the increasing tensions in the region that cannot be ignored. And on the coming back to the rupee, the monetary policy was almost as expected, and liquidity tightening was par for the course. Stock markets took a slight correction, with the dollar rupee, also took a good 15 paisa correction, which extended in the US hours, but has retraced back to around 80 to 75, 80 levels, along with the rebound in the dollar index. But the outlook for the dollar rupee, in my view, is that we might have seen a short-term top at 80 to 85, with persistent offers at 80 to 85 being, coming from the PSU banks holding it. Therefore, depending on the flows, one should not be surprised to see slip back to 80 to 50. And in fact, we did see some large corporate flows hitting in the late hours yesterday, which resulted in the dollar rupee falling. All in all, don't count on big direction move in these summer doldrums, but the moves will be very sharp, all within the range. Thank you.
Thank you, JK. And just to quickly summarize, RBI yesterday decided to hold rates, and the liquidity measures did not have any much of an impact. Rupee saw some strength later during the day. That was primarily because of some large flows. CPI data had a mixed response year on year, saw a little bit of decrease. We saw the official view yesterday by the San Francisco Fed daily, who said that inflation has not made much of a progress and sounded a little hawkish. While the jobless claims data, that also rose, and yesterday's 30-year bond auction led to some good rise in yields all across the board. So basically, expectations of rate cuts are moving further away, leading to disappointments in bets of a Fed pivot. So a lot of data also will be coming today from UK. Markets will be tracking that closely as well, and yen has weakened to almost touch the 145 mark, which is a sensitive level, as JK mentioned. In the short term, INR seems to have sort of made a top of at 82.85, and we'll see how things move ahead. That's it from us today. Thanks for listening, and tune in on Monday for another round of fresh updates. Thank you so much.